Is there a huge opportunity for American companies now in Venezuela? And how will the oil markets get impacted by Venezuela now working with the US? Our guest today is Professor Mische, who's been observing the oil markets. He's here to tell us the scale of this opportunity for US companies.
Being equal, if you're adding to supply 2 million barrels a day, you will have a favorable impact on prices in that the price will come down. The price of crude oil will come down. The price of crude oil comes down, theoretically, all things being equal, the price of gasoline will come down, and also the price of food products. There's a high correlation, very high correlation between price of crude oil, what's called the crude oil price index, and the food price index.
I'm Siamak, and this is Market Insider. Michael, it's great to have you back and welcome back.
Thank you so much. Great to be here.
We want to talk to you about oil and the outcome, the impact of what's happening in Venezuela.
First of all, Venezuela has the largest proven reserves of oil. There's more oil in Venezuela than pretty much anywhere else on the face of the earth. And at one time, Venezuela was the premier oil-producing country in the world at one time. Literally 60 years ago, if you go back to sort of the Kennedy administration in the early 60s, the standard of living in Venezuela was about 80% of that of the United States. That's how affluent and free enterprise that country was. Then they had a succession of socialists and then ending up with Marxists, beginning with Perez through Chavez and then Maduro. And what happened during that period of time has been the nationalization of industry. So these assets and these industries were expropriated and then nationalized. The professionals that actually ran it were replaced with, in some cases, people off the street. Over the course of time, Venezuela, which had been producing 4 million barrels of oil a day, is now producing around 600,000 barrels a day, and their infrastructure is completely debilitated. Venezuela will always, if it's producing oil, will have a positive influence on oil prices because it's increasing the supply of oil. The question is, how quickly can you produce that now and can you produce it responsibly and can you transport it? The large companies, particularly ExxonMobil, they've been in Venezuela for decades, but they lost their assets in Venezuela because Chavez and Maduro nationalized them. And they were kicked out and the assets were confiscated and expropriated to the Venezuelan government. So getting the large companies back in is going to be a slightly more protracted process. However, there's apparently great opportunities for some of the smaller operators to go in, either peripherally or directly or as joint ventures. That's being constructed as we speak. And understand that this industry, to rehabilitate Venezuela, oil industry, is going to run about $100 billion. That's just not my calculation.
So $100 billion of investment?
Investment, plus probably another $30 billion to remediate all of the environmental damage that these regimes have done. They have devastated their shoreline. Lake Maracaibo, which was one of the most beautiful lakes in the world at one time, is completely trashed. The president talked about pipes rusting. What he's meaning is the pipes in Lake Maracaibo, they're just crisscrossed. There's not even a map of them anymore that's accurate. They're just laid down willy-nilly and they're rusting. And so Lake Maracaibo is a toxic water refuge now. At one time, Venezuela had 4 or 5 glaciers too, way up in the hills, up in the mountains. Now they have none due to deforestation. About $30 billion in many decades is going to be required to rehabilitate the rainforests, Lake Maracaibo, and the coastlines, in addition to $100 billion of capital investment by American and European companies in particular to revitalize the oil industry in Venezuela, to get it operating safely. According to the president's plan, and I believe the first oil was sold just on Wednesday, Venezuelan oil, by the United States. The way that is going to operate is the United States will sell that oil at or near market price. Right now, the way Venezuela has been selling its oil has been considerably below market price, most of it to China.
Is it because of sanctions or is it just?
It went to China because China loaned them. China at least $54 to $100 billion loan to Venezuela. Venezuela pays that back through absurdly discounting its oil to China as payback. And so that's how they pay it. Then Venezuela also exports the oil to Cuba. And what Cuba does is, in exchange for the oil, Cuba has provided medical services, doctors, and a lot of military support. Cuba then takes the oil and they sell that oil to get U.S. currency or hard currency on the market. And who do they sell that oil to? China. The movement in Venezuela is far larger than just petroleum. It's really not about oil. It's part of a master geopolitical chessboard and foreign relations policy that the Trump administration is putting into play.
Would China not get the oil, or would it get it through the U.S., or would it get it at the market price now?
Let's all unwrap all of that. So it's my understanding China will still get its oil. It's my understanding that the oil that's being produced in Venezuela is going to come to the U.S., and we will sell it on behalf of the people of Venezuela. And we will sell it at market or at some negotiated price, but pretty much guarantee that whatever the price the U.S. sells Venezuela oil for on behalf of the people of Venezuela is going to be way better than the Venezuelans were selling their oil for to the Chinese. Apparently now trust accounts will be in place, and the transaction, the price of that oil, the sales price, part of that will go to the people of Venezuela, and some of that will go back to the United States. Because remember, when Venezuela expropriated these assets, they took on billions and billions of dollars worth of U.S. assets. They just took them for their own. So these companies, even though they have judgments against Venezuela, they're looking to get repaid. They lost their assets. So kind of a bit complicated. But I do think the way it's been designed should work quite nicely in operation. Should work. We'll see.
You mentioned assets. So can you explain what these are? Is it oil fields that people invested in? What
sure,
kind of assets?
Sure, they're oil rigs, they're oil fields, they're refinery assets, they're the ports or the terminals, they're pipelines, they're tankers, all of the infrastructure it takes to produce oil, refine it into a product, and get it to the market for us. So it's a large chain or supply chain of assets that the oil producers have invested in over decades in Venezuela. And it's their assets that were then just expropriated by Chavez and Maduro. It's one day you own it, and the next day you don't own it. They take it, and you're kicked out of the country, which is what happened. There's all these stories where I think it was Chavez went to the oil industry, Venezuelans in the oil industry, go to Miami because we don't want you. A lot of the talent that ran that industry, and it was a well-run company for many, many years. Let's not discount how well the Venezuelans were making oil, producing oil, and refining it. Okay, was well-run for quite a while. All of that talent left, or they were imprisoned, and they were replaced with literally people off the street, civil servants, and National Guard workers. We see the consequences of that. In fact, in 2015, Venezuela stopped reporting oil spills and environmental damage caused by the oil industry. There were just so many of them. They just stopped reporting it. The way the world sort of understood what was going on was through a lot of satellite reconnaissance, and you could see the oil, and you could see the pollution effects in Lake Maracaibo, the impact on the glaciers, and the impact on the coastline.
And the production level went down from 4 million barrels a day to
about 620,000 barrels a day.
Do you think the production in Venezuela will go up significantly in the next few years?
The goal is to bring it up to about 2 million barrels a day. That's the president's intent, but it'll take 100 million or so in capital. Getting it to 1 million, 1.5 million, doubling the production shouldn't be that tough, and the industry should be able to do that relatively expediently with a reasonable investment. But getting it above that will require significant infrastructure improvements, and that's where the rest of the 100 billion comes from.
You mentioned the conflict with China. What is the impact of oil in the middle of all of this?
There are 3 significant foreign influences in Venezuela: China, Russia, and Iran. In exchange for political support, in exchange for military support, in exchange for what few medicine that's available for the people in Venezuela. China has provided a lot of loans to Venezuela, about $54 billion in loans to Venezuela, plus another $50 billion in investment into Venezuela. They operate oil fields and they operate refineries in Venezuela. Venezuela is one of China's largest providers of oil. In exchange for all of that, they get a favorable rate per barrel, favorable price per barrel, and they've been just taking the oil over. And even under sanctions, they were taking the oil out of Venezuela. They were using what are called ghost ships. Ships are like airplanes in the sense that they have a transponder on them. And a transponder sends out a signal, and it'll tell you what the ship is. It'll identify itself. You can plot it on GPS. You know it's a tanker. You know it's a cargo ship. You know it's an aircraft carrier. But the ghost ships don't have that. So what we were able to reserve through satellite reconnaissance and intelligence was a lot of ghost ships coming in, taking the Venezuela oil out. Generally, that oil ended up in China, even though it was sanctioned, right? It ended up in China, and it would go to what are called the Chinese teapot refineries. So in China, we have basically two categories of refiners: the large state-owned refiners and independents up in the Jilin province northeast. And those are the small refiners, and they're called teapots. A lot of the sanctioned oil would find its way to the teapots. So the large Chinese refiners, the state-owned oil companies, could report, "Oh, we're not taking any sanctioned oil. We're getting our oil from Iraq and Indonesia," although over 90% of Iranian oil is consumed by China. So China's Iran's largest customer.
You mentioned 2 million barrels a day.
Right.
That's going to ramp up to from 600,000. How would that impact the oil prices?
Well, in economics, we have this saying called ceteris paribus, which means all things being equal. So if all things being equal, if you're adding to supply 2 million barrels a day, you'll have a favorable impact on prices in that the price will come down. The price of crude oil will come down. Now, if the price of crude oil comes down, theoretically, all things being equal, the price of gasoline will come down, and also the price of food products. There's a high correlation, very high correlation between price of crude oil, what's called the crude oil price index, and the food price index. So as we saw when energy costs went up and they reached an all-time high for gasoline in June of 2022, what did we have? Extraordinarily high food prices. When we add supply of oil to the world, given all things being equal, we'll have a reduction in price, generally a reduction in price. It has a favorable impact on the consumer. The problem that you have is if the price of crude comes down too much, then the producers of the crude oil aren't incentivized to produce it. And probably more interesting or alarming for me at least, is they're less incentivized to invest their capital in that because it's not going to have a great return on investment for them. Right now, we're sort of looking for Brent price to be somewhere between 55 and 57 for 2026, and it may even come down a little bit further. At that price point, it becomes unattractive for some producers. So they'll reduce their production and slow down their capital expenditure. But we'll see. Oil's the great commodity. The price can change in a minute. Anything can happen in the world that can affect the price of oil.
How much are these energy companies, like you mentioned, the oil companies, how much are they impacted by the price? Does the price of oil make them the higher price of oil make them a lot more valuable? Are they hedged on that?
There's a lot of hedging that goes on. If you're looking sort of what makes them valuable would be their technology and their access to the oil. Do they have access to it? And then, of course, the up and down of the crude price. Again, when crude prices are falling, if they fall too far, there's no incentive for that producer to make oil. They'll just sort of shut down or slow down the production until the price comes back up and they'll start producing. Right now, what we're seeing is a modest reduction in consumption, an increase in production, and an increase in oil inventories. So that's what's happening right now. That's why in California, the price of gasoline has come down. It hasn't come down because of any policies Sacramento has made. It's come down because the price of crude oil has come down. And that's true across America. So the price of crude is the determining factor. It not only makes a determining factor on us as consumers, but on the choices that the business executives will make when they're allocating their capital. So when the price is high and demand is growing, you'll see more production and higher allocations of capital for production. When demand is starting to abate somewhat and we have a surplus, which we're beginning to see being formed now, that will theoretically slow down production and slow down capital expenditures.
What is the impact of oil prices and oil on our general economy? So when the oil price is coming down, how does it impact us?
In general, energy prices, particularly oil, will account for about 30 to 33% of inflation. The largest lever or the largest impact you might have for inflation would be energy costs. And oil is the largest component of that. And we learned that lesson the hard way in the 70s under the Arab oil embargo of 1973 and then subsequent years in 77, 78. And then if you take a look at what happened under the Biden administration when there was this big political sentiment and rotation away from fossil fuels for the renewables, and we're going to restrict production on federal property, and we're not going to allow pipelines, and we want you to reduce production. Well, what happened to the price of gasoline? It reached an all-time high in June of 2022, $6.40 a gallon. It's never been that high on average. And what happened to the food prices? Spiked. What happened to general inflation? Reached 9.1%. We're complaining about inflation now to be what, 2.7%? It was 9.1 just a few years ago. Energy prices have a huge determining factor on the cost of living and inflation, not to mention the hundreds of thousands of people that are employed by the industry. So huge.
In terms of the industries that would benefit from lower oil or excess supply of oil, which are you predicting an excess supply of oil after this Venezuela move?
Well, aviation. More oil means the ability to have more jet fuel. More jet fuel should have a moderating impact or influence on prices. So we would see, hopefully, less of a price increase as a result of that for our airline tickets.
Or the companies will be more profitable.
And the companies will be more profitable. If they're more profitable, a couple of things will happen, right? Well, several things will happen. One, they'll pay more taxes. Two, that leaves more capital for them to invest in the future. We run on capital investment in our economy. Despite what a lot of people may think to the contrary, we still are a capitalist economy, which requires capital investment. And so the profits or that cash flow feeds that capital investment. That's very, very important to us. And then, of course, it's employment. These companies, when they're doing well, they hire people. So we create jobs as a result of this.
What other spaces can you think that would get impacted as well, besides aviation?
Well, food production. We have oil used, or hydrocarbon molecules used extensively in the production of food for agricultural purposes. We find it in fertilizer in particular. But remember, all our farm equipment is going to run either on gasoline or diesel fuels. We see an impact in that. Trucking, for example, you're moving product from point A to point B, whether that's across the country or just simply from Irvine to Los Angeles. It's on a truck. That truck has an operating cost associated with it. And so when the operating costs are high, the cargo rate goes up and it's reflected in the price. When the cost of fuel goes down, the operating costs tend to come down a little bit and they're reflected in the price. Same way with all the maritime ships coming across the ocean, right? They're burning fuel. The higher the price of the fuel, the higher the cost for transportation. The lower the price for fuel has a moderating impact on the transportation. So we see it basically everything. Remember, petroleum is in over 6,000 daily products. You know, when you're using your cell phone, there's a petroleum hydrocarbon molecule in there. When you're driving in your car, let's say you have a Tesla, which is an EV, which is great, it's fine, but it has plastics and products in that car that have petroleum molecules in it. It has a profound impact on our daily lives and on the economy.
Let's say when the price of oil goes from like $80, $90 to 50, 60, does that savings, for us consumers, we don't see the savings physically, we might not see them, maybe on the gas pump, but we don't see them in the products. Or does it make it to the products?
It'll make it to the products, but remember, it has a big lagging effect by the time it gets into a product line. But you'll have an immediate impact on your gasoline prices, diesel prices, and hopefully utility prices, although not so much in California, but in other parts of the country where they use natural gas or they use oil for heat or they use fossil fuel such as oil or natural gas to generate electricity. If that price is coming down, then that would be reflected in our everyday bills. And you would certainly see it reflected in agricultural production costs. So food costs would come down.
So if the prices and these costs come down for the consumer, does it improve the economic growth? Does it impact the economic growth?
Yeah, I mean, look, the United States economy is a consumer economy. It's built on free enterprise. It's built on consumption. What we know, and it's been proven many, many times over, is consumption drives our economy. Consumption and capital formation and capital expenditures, those three things propel the American economy. And it's kind of interesting when I look at the news and some of these surveys right now, you'll see where, well, people are like, well, I don't think the economy is that good. You're spending a lot of money. Something must be pretty good. You're spending a lot of money. We're seeing that. We saw it over Christmas. We're seeing it right now. The American consumer is spending a lot of money. And that means their confidence is going up. They may not express it directly on some survey, but what we're seeing is exceptional spending, and that drives economic growth in our country.
In terms of you mentioned the 2 million barrels a day, potentially under the U.S.'s control, which means more stability.
Correct.
What's the impact of that stability on the economy? The more the U.S. controls like these resources, which these countries probably will get compensated fairly.
Oh, yeah.
And the supply will stay. What's the impact of that security side of it?
Well, the good news for us is that under this particular administration, under President Trump, we are energy dominant, and we are energy independent. We are an exporter of energy. We're an exporter of oil. And in fact, our production hit an all-time historical high of about 13.6 million barrels a day just recently. So it's all-time high for us right now. And we have more oil. We're discovering more every day. The Venezuelan oil complements that. It adds to that. And anytime you can add to that, you're adding to the stability of supply, and you're also adding to sort of price certainty. Now, most of that oil that's coming from Venezuela is destined for Louisiana and Texas refineries. It's not coming to California. It's going to those refineries, or it's going to be pre-treated and sold on the global market to somebody else. But for American purposes, it's going to go to those refineries on the Gulf Coast. But it adds tremendously to our security, our stability, and price certainty.
For investors that are looking at the situation in Venezuela and they're looking at oil companies to invest in, do you have any thoughts for them?
If you think about oil, we will be off of oil at some point in time, but not totally off of oil, because you're going to need petroleum to just even make asphalt. When we look at the long-term projections of oil demand, it's going up at least through 2045 to 2050. Most of us who follow the industry and build our models have it kind of plateauing around 2050, maybe stabilize, and then I have it having a decline around 2055, and that'll be a relatively constant decline. So if somebody's looking to invest in a stable product, I mean, those oil companies pay a lot of dividends. CalPERS, the largest
California Pension,
the largest pension organization, I guess, in the United States, has invested heavily in oil and gas companies because of the dividends that they throw off of them. And at one time, CalPERS actually owned Chinese oil companies and Russian oil companies in that portfolio. Irrespective of all the issues about climate change and things like that, at least for CalPERS at one time, it was an attractive investment. So they spin off a lot of dividends. They do have a long-term growth curve. When you look at these American companies, Chevron and Exxon, Valero, these are well-managed companies. The people who run those companies are extraordinarily adroit business people. They know how to run a company. They know how to make good decisions on behalf of their shareholders. Irrespective of some of the demonization of those companies, these are responsible companies. The United States has the best petroleum companies in the world. They run very tight. They run with great responsibility for the environment, and they run with great responsibility for the law. If an investor is looking for sort of that type of profile, these companies are going to be around for a while. Not to mention how much they're investing in renewables and alternative energy sources. They know that, oil is not going to be their primary source of income in 90 years or even 70 years. But they have an ambition of maintaining continuity of that company and remaining relevant. So they're spending a lot of money on innovation right now.
Professor Mische, thank you for coming on Market Insider.
It's been terrific. It's always a delight to be with you. Thank you.
What do you think about the impact of oil coming from Venezuela? Do you think this is going to benefit American companies? You can always comment. We read all of your comments. I'm Siamak. This is Market Insider. We'll see you next time.